Okay, so again, scenario covering these 5 questions. Let's have a look at the first question then. Which of the following must exist if you're going to call something a discontinued operation? So, the operation must represent a separate major line of business. Yep, that is true. The operation is a subsidiary, not necessarily. The operation has been sold or has been held for sale. Yep, that's true. The operation is considered not to be able to make a future profit. No, not that. It can be profitable. So, yeah, the answer is C, 1 and 3. Question 22. IFRS 5 then prescribes the recognition criteria for something to be held for sale. For an asset or disposal group to be classified as held for sale, the sale must be highly probable. Correct. Which of the following makes it highly probable? A buyer must have been located. Not necessarily, not yet. The asset must be marketed at a reasonable price. Yes, I agree with that. Management must be committed to a plan to sell the asset. Yep. The sale must be expected to take place within the next 6 months. No, within a year. Okay, so it's within a year, and therefore the answer is A. Question 23. What is the employee cost associated with the closure of this factory? So what's the employee cost? Let's have a look. Closure of the factory. So they're closing down a factory, and of the factory's 250 employees, 50 will be retrained, so they're for the future, and deployed to other subsidiaries, while at a cost of 125,000. The remainder are made redundant. So it's the remainder, the other 50, the retraining cost, well, that's a future cost. So it's the other 200 employees, and they're going to get a redundancy at 5,000 each. So 200 times by 5,000 is 1 million, and so the answer is D. Question 24. What is the profit or loss on the discontinued operations relating to property and plant and equipment for the year ended 30 September X3? So remember, you take it from its carrying value and you drop it into current assets held for sale. And it's how much do you drop it in at? Well, the lower of carrying value and fair value minus cost to sell, because we're about to sell it. So let's have a look at this then. The factory had a carrying amount of 2.2 million. So there's the carrying amount. It's expected only to sell for 500, incurring 50 selling costs. So fair value minus cost to sell is 500 minus 50, 450,000. So it's going to fall from 2.2 million, and we're going to drop it into held for sale at 450,000. So what's that? 200 minus 450, a loss of 1,750,000. Let's hope that that's there. 1.75 million loss, yet 24A. Final question then. In respect to the operating leases and penalties, what provision would go in the accounts? Let's have a look what that's referring to here, presumably. The company rented a number of machines, under operating leases, and they have an average of 3 years to run. The present value of these future lease payments was 1 million. However, the lessor has stated they'll accept 850, if paid on 30th of October 2003 as full settlement. So we can bring in a provision for the full 850 then, can't we? Not the 1 million, they're allowing us, they're letting us off with just having to pay 850. But there's a penalty payment due to the non-completion, estimated to be 200,000, so it's plus 200,000, which is 1,050,000. 50% of which is expected to be recovered from insurers. Well, that's what we call a contingent asset. And that contingent asset, it needs to be virtually certain in order for us to bring it in, and it says only expected to be recovered, so that's not enough to bring in anyway. But also, it wouldn't net off against the provision. You do set them off separately, or you do show them separately, the potential assets and potential liabilities. So the answer is 1,050,000, which I'm hoping there it is. 25. The answer is C.